Welcome back to Iron Financial. We're the place you come to forge a stronger portfolio because we cut right through the market's weakness. And today, oh man, we are putting one of the world's most important companies through the ringer. We're talking about the semiconductor foundry that literally builds the brains for Apple, for Nvidia, for pretty much everyone who matters. Their latest earnings just hit the wire, and the numbers, they are absolutely massive. So our job today is simple. We're going to figure out if this giant is built on a foundation of solid rock, or if it's all just shifting sand.
Okay, let's just get right into it. The very first thing you have to wrap your head around is the sheer raw momentum behind this stock. Just look at this number on your screen, 150% surge. That's in the last year alone, and it's trading right near its all-time high. Now, this isn't just a little bit of investor confidence. No. This is a roaring, stampeding bull market all concentrated into one single name. The critical question we have to answer, the one that matters, is whether that roar is actually justified by the fundamentals, or if it's just a whole lot of noise.
Whoa! Okay, let's just pump the brakes for a second. 150% run? I mean, that's incredible, but it also sets off every single alarm bell in my head. And that really is the core conflict, right? That's what we're here to analyze. Is this unbelievable valuation actually justified by fundamentals that are, indestructible, or is the market just completely trapped in an AI hype bubble that's stretched so thin it's about to pop? Are we looking at a fortress of finance or just a house of cards waiting for a breeze?
That is exactly right. So for our first section, we're going to put that very hype to the ultimate test. We're weighing the market's almost euphoric, gotta-have-it sentiment against the cold, hard, unforgiving financial reality. You can think of these earnings as the structural blueprints for this entire market valuation. And our job is to run a full-on stress test on that design and see if it can actually handle the immense, almost crushing weight that the market has decided to place on top of it.
Yeah, and let's be perfectly clear about what that weight really is. The market isn't just hoping for a good quarter. It's not looking for a solid report. No, the market has priced this chip titan for nothing less than absolute, flawless perfection. Any sign of a crack, any tiny miss on a single metric, any hint of weakness in their future guidance, and this entire structure could experience a seismic shock. The pressure on them to deliver is just unbelievable.
And that is our mission today. We are not here to ride the hype train. Forget the hype, forget the sentiment, forget the stock chart for a minute. We're here for the load-bearing numbers, the real pillars holding everything up. Our job is to take a financial sledgehammer to these results and just start hammering away to see if the foundation holds. So let's get to work.
All right, Section 2, it's time to deconstruct this record-breaking quarter. We're done with the stock price, we're moving into the engine room now. We're going to examine those core, load-bearing numbers that are supposedly supporting this entire valuation. This is where we separate the hard facts from the market fiction. So let's start right at the top line, revenue. Management guided the street to expect a number somewhere between $34.6 and $35.8 billion for the first quarter. That was the official range. Well, they didn't just hit the top end of that range. They didn't just nudge past it. They smashed right through it, posting $35.9 billion. This is not just a beat, people. This is a powerful statement about the overwhelming, insatiable demand they're seeing from every single corner of the tech world. Now, a big number is one thing, but let's add some critical context to it. Look at this. This is a dual-engine growth story. Year over year, revenue is up an absolutely astonishing 40.6%. That is just massive scale. But here's what's so crucial. Look at the sequential growth. Even when you compare it to a very strong fourth quarter, revenue still grew another 6.4%. This tells you the company isn't just growing, it's accelerating. It is firing on all cylinders, full throttle. Okay, revenue is strong. I'll give you that. But for me, this right here is the real test of strength. Gross margin. See, any company can go out and chase revenue. You can buy growth, but profitability, that's where the true quality of the business is revealed. They guided for 63 to 65%, which by the way is already an incredibly elite number. To then come in at 66.2%, wow, that is a raw demonstration of immense pricing power. This is TSMC acting like the essential toll road for the entire AI revolution. If you want to build a cutting-edge chip, you have no choice. You have to pay their price. This right here is the financial bedrock we were looking for. And that incredible strength in the gross margin, it creates a powerful ripple effect all the way down the income statement. Let's move to the operating margin. This is where you see the raw power of operating leverage in action. The beat on gross margin amplified their profitability even further. They guided the street for 54 to 56%, and then they delivered a massive 58.1%. So what this means is, for every single dollar of sales that comes in the door, more and more of it is dropping straight to the bottom line. This isn't just a profitable company. This is a fortress of profitability.
The numbers are undeniably strong. You can't argue with them. But why are they so strong? Where is all this power coming from? We have to pinpoint the source. We need to know if this is just broad-based strength across the board or if it's coming from one specific, maybe unsustainable part of the business. Is this high-quality growth that can last, or is it just some kind of temporary surge?
That is absolutely the right question to be asking. And the answer? Well, it lies right here, deep in the engine room of TSMC's profit machine. This is the breakdown of their wafer revenue by technology node. Just look at the two biggest slices of this pie, 3nm and 5nm technology. These are their most advanced, their most complex, and crucially, their highest margin products. Together, they represent a combined 61% of total revenue. This is the stuff that the AI giants desperately need, and TSMC is effectively the only shop in town that can deliver it at scale.
Let's just hammer this point home so there's no confusion. If you combine everything at 7nm and below, which is what the company itself defines as its advanced technologies, you get to this number, 74%. Nearly 3/4 of the company's entire revenue stream is coming from its most cutting-edge, its most defensible, and its most profitable technology. This isn't just a competitive moat they've built, it's a vast ocean. The power is coming directly from their complete and utter technological dominance.
So, we've established the foundation is solid. The performance in Q1 was, frankly, spectacular. But we all know markets are forward-looking. So now, we shift our focus from what they just did to what they plan to do next. In Section 4, we're analyzing management's actual blueprints for growth. What does their guidance and, more importantly, their investment strategy tell us about the future strength of this entire structure?
Well, the guidance for the second quarter is just incredibly bullish. They are projecting revenue to grow sequentially by another 10% at the midpoint, landing somewhere between $39 and $40.2 billion. And then look at the margins. They expect to sustain these historically high, eye-watering levels, guiding for a gross margin between 65.5% and 67.5%. There is absolutely zero sign of a slowdown here. In fact, it's the opposite.
And here's the part that's really, really crucial. It's not just about the Q2 guide. They actually raised their forecast for the entire year. They are now telling the market to expect full-year revenue growth to be above 30%. You have to understand, raising your full-year forecast this early in the game is a massive signal of confidence. It tells you that management's visibility into future demand isn't just good, it's crystal clear and incredibly strong. They know the orders are coming.
But this is where I start to see a potential stress point. $52 to $56 billion. That's their capital expenditure budget for a single year. That is a colossal, almost incomprehensible amount of money. I mean, they're spending more on CapEx than most major corporations generate in total revenue. So the big question for me is, can they really deploy that much capital that fast and do it effectively without just crushing shareholder returns in the short term? That is a huge execution risk.
That is a fair point. But let's look at how the CEO, Dr. C.C. Wei, frames it himself. He's basically saying this isn't just spending, it is a direct investment in future growth. He's drawing a straight line, a direct correlation. The more we spend today, the more we're going to grow tomorrow. They see the demand from AI and high-performance computing not as a cycle, but as a multi-year structural shift in the world. And they are spending whatever it takes to build the capacity to capture all of that demand and secure their dominance for years, maybe decades to come. They're not just reacting to the future, they are actively forging it.
Okay, the bull case is powerful. I get it. The numbers are strong, the guidance is confident, but no structure is ever perfect. For our analysis to be truly complete, to be ironclad, we have to deliberately go searching for the cracks in the armor. So in this section, I'm taking the lead. We are going to inspect every potential fault line and every headwind that could possibly derail this entire growth story. We need to know what could go wrong.
And look, these risks aren't just me speculating. They come directly from the company's own reports and their conference call. Let's break them down. First, margin dilution. The ramp-up of their brand new 2nm tech is going to be expensive, and they are telling us flat out it's going to hit gross margins by 2 to 3 percentage points this year. Second, geopolitical risk. They are explicitly flagging tensions in the Middle East as a source of macroeconomic uncertainty that they are watching. Third, as I just talked about, the sheer scale of the CapEx. That is a massive execution risk. And finally, if you dig into the balance sheet, you see a notable increase in current liabilities, things like accrued liabilities and accounts payable. These aren't just hypotheticals, people. These are potential stress fractures that we absolutely cannot ignore.
All right, we've laid out the incredible strengths.
And we have thoroughly, and I think fairly, inspected the potential fault lines. So now it is time to deliver the final judgment. It is time for the iron verdict. We're going to weigh all the evidence and answer the ultimate question for any investor looking at this. Is TSMC at these sky-high levels a generational opportunity, or is it a dangerous trap?
And it's not just our analysis. Let's bring one more heavy piece of evidence to the scale. Goldman Sachs, one of the biggest hammers on Wall Street, just came out and reiterated their buy rating. But they're not just holding the line. They are raising their price target to $550 a share. And their reasoning? Well, it mirrors our own analysis almost perfectly. Stronger AI-driven demand and higher gross margins. This is powerful reinforcement of the bull case from a major institutional player.
So, here it is, the iron verdict. After hammering the numbers, after stress testing the financials from every angle, our conclusion is clear. The structure is sound. The foundation is solid reinforced concrete. Those risks we identified, they are absolutely real, but we view them as manageable pressures, not as structural fractures. The company's financial integrity is more than capable of handling the load. So, for investors with a long-term horizon, this looks like a clear opportunity to own the undisputed leader in a sector that is being fundamentally reshaped by a technological revolution.
So the financial verdict is in, the structure holds. But I do want to leave you with one final thought, something that goes way beyond the balance sheet. This AI revolution is fundamentally reshaping the entire tech industry, top to bottom. For a titan like TSMC, the biggest challenge is no longer about financial stability. It's not about finding customers. Their order books are full for years. The real, defining challenge is now operational. Can they physically build factories fast enough to meet the insatiable exponential demand of this new era? The question isn't whether they can survive. The question is whether any company on Earth can truly keep up.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.